Good afternoon, and thank you for joining us for the third session in our four-part series focusing on transaction service basics for business owners, hosted by the Michigan Manufacturers Association and the closely held business experts at Clayton and McCurvey. We've been providing resources and insights to manufacturing business owners who may be considering a transaction or those who may already be in the process. Today, we'll be focusing on due diligence and the common issues that surface during this phase of transactions. My name is Caroline Leithen, and I am Director of Environmental and Regulatory Policy for the Michigan Manufacturers Association. MMA is the only statewide organization focused solely on securing a prosperous future for Michigan manufacturers through effective advocacy, meaningful education, and strategic business services. We represent nearly 1,700 members, ranging from small mom and pop shops to the world's largest and most iconic corporations. Facilitating today's discussion will be Jim Beal, a shareholder with Clayton and McCurvey and the firm's leader of manufacturing and distribution. Jim has been with Clayton and McCurvey for over 25 years, providing clients with strategic solutions that generate tax savings, solve operational issues, and provide peace of mind. Before we get started, I've got a bit of housekeeping to cover. We hope that today's discussion will be interactive, so please feel free to use the Q&A function to share your thoughts and questions for Jim, Ben, and Nick. There is a button toward the bottom of your screen that you can click to open the Q&A screen. If you're having any technical issues, you can enter them in the chat function, which is also found in the taskbar at the bottom of your screen. After today's session, we will be sending you a recording of the discussion as well as the slides, so watch for those things in your inbox in the next 24 hours. Now we have a fantastic panel of professionals ready for what we expect to be a dynamic discussion this afternoon. Without further ado, I'll hand it over to you, Jim.
Thanks, Caroline. As Caroline mentioned, my name is Jim Beal. I'm a shareholder at Clayton and McCurvey. Yes, I head up our manufacturing and distribution group. I want to welcome you to today's session. It's all about the due diligence, which is the third of a four-part series that we put together to try to get additional information and education to owners of closely held businesses as well as the management team as to the M&A transactions. The first session that we did back on May 6th was an overview session that was presented by Tim Hilligus, who is one of our shareholders here at Clayton and McCurvey. The second session, The Art of the Deal, we had an investment banker, Bob Quarry, that was on. We had an attorney, Jim Wagoner, that was on, as well as Tim Hilligus, that talked about who are the participants, who are your advisors, and the interplay of the advisors that are out there. Both of those sessions are available on the MMA and the Clayton and McCurvey website. So if you miss those two dates, by all means, go out and you can view them. They're a good overview session and a good dynamic discussion amongst the advisors. Today is the due diligence, but we've got the last one coming up. You can mark your calendars for June 24th, post-closing. The idea there is to try to get some information as to, you have an illiquid asset, it turns into a liquid asset, and there's a variety of different things that you need to anticipate and plan for. So we're going to have a good discussion on that on the 24th. So by all means, please mark your calendars. Ben, if you can turn to the next slide. Takeaways from today's session. It's a little bit of a 40,000 foot view, but what is due diligence? Understanding the process, what information is requested and by what parties, when do they need it, why do they need it, common issues identified, and deal impacts. Also, again, as Caroline had mentioned, use the question button. We love to get questions. We try to respond to the questions during the middle of the presentations. We'll stop and break and take questions. So fire them off there, and we'll try to get those back to you. Next slide, Ben. The speakers. Two speakers today. First, Ben Smith. Ben is a senior consulting manager at Clayton and McCurvey, where he provides advisory services to middle market, closely held clients in the manufacturing and distribution sector. Ben specializes in transaction support services, including financial, tax, and deal analysis, quality of earnings studies, and due diligence work for clients buying and or selling businesses. Welcome, Ben. Next will be Nick Lloyd. Nick is a tax principal at Clayton and McCurvey. He has a prior experience with national accounting firms supporting client transactions in manufacturing as well as other industries, and at a director level with a big three automotive company handling predominantly M&A activity. He specializes in advising business owners on mergers, acquisitions, and reorganizations. Welcome, Nick. I will turn it over to Ben. I think you're going to start it out. So take it away, Ben.
You bet. Thanks, Jim. All right. So as Jim mentioned, feel free to pepper in questions here as they come to mind. We're here to help you guys out the best that you can and welcome questions. So kind of setting the table from where we might have left off in prior parts to this series, you've got a signed LOI in hand. Now what happens, right? Well, now comes the due diligence. So remember, an LOI is, for the most part, non-binding, right? So the biggest piece, the purchase price, is non-binding. There's no guarantee that that's what you're going to get. What a buyer is interested in now and figures out through due diligence are the conversations that you've had pre-LOI, are the the information that you might have shared with him pre-LOI, being financial statements or maybe redacted customer sales by customer schedules and things like that they use to price the business. Are those things reliable? They want to validate those claims that you've made to make sure that they put the right price on this business. In addition to that, they're looking to understand the obligations of a business, of your business, the contingent liabilities, problematic contracts. So things like perhaps you have a purchase commitment with a vendor and you're expected to buy X amount of raw material between now and the end of the year. Well, that's something that the buyer needs to understand and wants to figure out if that's going to fit into their long-term plan, or if that turns out to be some type of liability that they don't really want to deal with or pay off, right? So they do a lot on the kind of risk management side, understanding your liabilities and obligations. Maybe you've got a deferred pension where they're going to have to deal with how do they pay those people out at some point in the future, all kinds of things. And that's kind of their goal here. Let's get to know each other a little bit more deeply and get some real facts and documentation behind that. Due diligence is typically a 60 to 90 day exercise. Sometimes it might be more than that, but typically they try to get due diligence and a good part of the purchase agreement completed in that exclusivity period in the LOI, which is one of the binding provisions. So once you sign an LOI, if you remember from the prior series, you have about 60 to 90 days of exclusivity where the seller has made a promise to the buyer that we're not going to go out and market this business to anybody else. So you can feel relatively confident in making the monetary and time investments and going through the due diligence process to understand our business. Buyers often involve multiple advisors throughout this process. They'll look to involve legal advisors and attorneys. They'll involve accountants, maybe environmental engineers, human resource professionals. They might bring in consultants that specialize in marketing or operational due diligence. They might bring in cybersecurity experts, insurance experts. At the end of the day, they're bringing in a pretty diverse team if they're a sophisticated buyer to analyze your business. We recently did about a $20 million in value deal, and the buyer had about 50 participants on their side to give you kind of a scope. Deal sophistication, buyer sophistication, that will vary, but there can be quite a few people that are involved from a buyer side. And all of those people's goals is to get information from you and analyze it, right? So week one, post LOI, you may get 6 or 7 different request lists from all these various teams or various tracks. And each one of those request lists will have multiple documents requested, questions for you, and pretty much everything that these teams are going to need to complete their work. And that can quickly amount to hundreds of items requested during the early on in the due diligence process. And, as sellers, if you have an investment advisor, an investment banker, they'll help you navigate that process. And what they'll typically do is set up what's called a virtual data room, or a VDR. And if you're representing yourself, this is something that you're going to want to do on your own. what a VDR or virtual data room is it's an online portal that you can securely transmit information from the seller to the buyer, okay? And what will typically happen is you'll get all 6 or 7 request lists, and you'll kind of take that information and abstract that and kind of compile that information into the VDR in a logical fashion where you're going to put all your financial information over here. Maybe your customer information goes in a separate folder. But at the end of the day, you compile all that information into a VDR. And then on these request lists, you just go through and simply reference the index that these documents are related to on the individual request list tracks. And what that really does is, A, it makes you a little bit more sane throughout this process. B, it really helps when you're 30 or 45 days into diligence and some particular issue comes up and you're trying to figure out, who's seen this document and make sure that you're all looking at the same document. You've got one consistent location that both sides, both deal teams can look at. In addition to this, if you're thinking about selling, one of the things that you can do is set up a data room in advance and start to populate some of these things. I'd say about 80% of the information is kind of consistent from deal to deal, and then the other 20% varies. You can get a pretty good head start on populating a lot of this information in advance. So that way, when you roll into due diligence, you have kind of a leg up on the game. Throughout the diligence process, buyers will look at other things other than just validating information. They'll start considering how they're going to integrate your business into theirs if they're going to do so, if it's not a standalone platform. We're not going to get too much into that today in those other areas. We're going to stay pretty focused on talking about the types of things that buyers will be looking at and how that might impact you. So understanding the gravity of the teams, the expertise, the amount of information that buyers will be requesting from you during due diligence, you might be wondering, like, well, what happens if they find something? Perhaps one of a buyer's questions says, do you have any ongoing income tax audits? Yes, I do. Well, what does that mean for you? What should you do about that? And we're going to talk about that next here. And actually, Nick's gonna jump in and tell us what typically happens when things are discovered throughout the process of due diligence.
Thanks, Ben. And thanks, Jim and Caroline, for the introduction. And thanks to all of you for attending. Hopefully you're poolside somewhere. But I'm mainly here to talk about the tax due diligence process, which I'll go through in a few minutes. But in the meantime, I'm going to give Ben a chance to catch his breath and talk about what to do about some of the issues that are uncovered during the due diligence process, what the buyer can do about those. And there's really a range of possibilities. They go from the lightest touch, they can work some language into the purchase agreement or the reps and warranties, to the most extreme option for the buyer, which is that they could walk away from the deal could fall through. And that's usually a last resort. Usually they'll work through these issues with the seller, try to come to a compromise. So as I stated, first step, they'll go through the purchase agreement. Is it possible to build some reps and warranties? Ben used the example of a tax liability or a tax audit. Can we put in the agreement that the seller is responsible for that any assessment that comes from that, the seller will pay? They can build that into an escrow so that the money is set aside, so that if this assessment comes along, that it can be paid out of that. It's a little bit harder with tax assessments because the statute of limitation goes on for so long. In some cases, it can be 3 or 4 years or even longer. So most agreements don't have an escrow in place for that long. So we'll talk about in the tax section some of the other options that are available for the buyer. But there can also be an adjustment to purchase price. If the buyer was planning to pay X and there's a potential liability, they can offer a lower price to make up for that liability that might come along. And as I said, ultimately, if the buyer and the seller can't reach resolution on these issues, then the buyer will just have to walk away. So we can move on to the next slide.
All right. Yeah. And I think from a seller's perspective, once you sign the LOI, control kind of shifts to the buyer to a degree. They get a bit of an upper hand in negotiation. So throughout this process, as you look at some of these things, that might occur. Really, I see the seller's job, their advisor's job, as to continuously go back and try to keep the deal and any findings mitigated and this deal as close to what you saw in the LOI as possible. So we're going to talk a little bit more deeply about some of the different areas that buyers pursue during due diligence. So I'm going to kind of give you a high-level overview of the areas that we see most common in manufacturing businesses in the middle market. And at the end of this kind of section, Nick and I are going to go a little bit more in depth into tax and financial issues, which is where most of Nick's and my own expertise lies. But at a high level, buyers will be interested from a legal standpoint in doing diligence and bringing attorneys in to review kind of general corporate matters. They'll look at your charter documents, bylaws, articles of incorporation and organization. Pretty much if you have an in-house attorney or you work with an attorney, all the documents that they've created for you over the years to run your business are things that the buyer is going to want to see. They'll dig into your minutes of meetings and board of directors meetings to understand what actions and issues you might have taken over the past. They'll look at stock option plans. If you guys have those type of things with employees, they'll spend a fair amount of time digging into all of your material contracts with customers and vendors alike. So often what will happen in this process is, the purchase agreement will start being drafted during this due diligence period, and the seller will be responsible for disclosing a bunch of information and repping and warranting that. One of the things that they'll disclose often are all material contracts with customers, for instance. So they might set a value that any customer contract in excess of $50,000 has to be disclosed. You have to put that in your data room, and then the buyer's attorneys are going to read through it for issues and concerns. Oftentimes, what you'll see in those types of agreements are provisions for change in control, meaning your customer enters into an agreement with you and says, we'll buy X from you under these terms, but if you change ownership in this process, this deal is pretty much null and void. And one of the things that you start working on in due diligence is identifying those contracts with those type of provisions and figuring out between you and the buyer how you're going to deal with those types of things, how you're going to go about getting customer consent to make sure customers don't up and walk out the door the minute that this transaction is announced. Buyers will also look at your intellectual property, patents, trade secrets, their attorneys more specifically, to make sure that any IP is protected adequately. They'll look at your employment agreement with employees and other types of contracts. They'll look through any pending litigation that you might have ongoing or a history of litigation and all sorts of things kind of in that realm, right? Operationally speaking, buyers often will send in their own teams if they're in a similar industry to do operational due diligence. If it's a new industry to them, they might bring in some consultants. But operationally speaking, they'll go through and look at your quality control and quality control processes from a manufacturing perspective, look at your history there. They'll review the state of your equipment that you're using. They'll look at the subcontractors that you're using. They'll look at kind of major vendors that you have and look for risk concentrations there. And then these days, especially post-COVID, they'll get a little bit more deep into looking at your supply chain resilience, right? Oftentimes, when you sign an LOI, part of the financial information that you've given the buyer to price your business is based on projections, and they're going to look at those projections and want to understand, well, are you having any supply chain issues, microchip shortages that are going to prevent you from delivering and meeting these sales targets, and thereby perhaps introduce some risk into the price that they're paying for your business. They'll also look at a history of meeting kind of customer deliverables, and they'll look at customer satisfaction. They'll look at your insurance. Oftentimes they'll bring an insurance specialist to analyze, were you overinsured, were you underinsured? Is the buyer's insurance policy going to cause some type of price gap where, yeah, we thought that EBITDA was going to be $2 million, but you're underinsured, so we're going to have to pay an extra $100,000 a year in insurance. So now we're going to give you a price adjustment for that, right? They'll look at your business from an environmental perspective. Most oftentimes they'll use environmental engineers to do this and do what's called a phase 1 study to identify any environmental contamination that you may have on site. So if you got some toxic waste in the basement or something like that, that's something that they're going to be concerned with. On the regulatory side of things, if you're a highly regulated industry, they're going to spend a lot more time here. They'll look at FDA, USDA, EPA, OSHA type regulations and make sure that you're in compliance with any of those type of regulations. Healthcare industry is a big one if you guys are manufacturing any products in healthcare. And they'll look to make sure that they're not stepping into the shoes of a business that is out of compliance with regulations and might get hit with some type of fine day 2 after closing. All right. From an HR perspective, they'll look at your employee base. They might do compensation studies to understand whether your employees are undercompensated or overcompensated and how that might impact their cost structure on a go-forward basis. They'll look at your history of labor disputes. They'll look at allegations of misconduct, employee benefit plans. They'll dig deeply into those plans and look for how they've been operated and administered. Look to see if there are any errors in your plans that might cause them a liability. Oftentimes, we've seen where sellers might have had to just close down their plan because they've had some errors in the past and are worried about kind of tainted assets moving into the successor's 401k plan. They'll also look at incentive equity and other non-cash equity plans that you might have in place with your employees and phantom stock plans to understand the liabilities that are going to occur on a potential transaction to make sure that those liabilities are paid off in full when the business is sold, to make sure that they're not stepping into the shoes of a bunch of employees who didn't get what they thought they were going to get and are ready to walk out the door, right? They'll look at your classifications of employees versus independent contractors. If you have a history of using independent contractors that are really employees of the business, that might be a concern of theirs, especially from a payroll and other classification perspective that might create liabilities that they'll want to kind of separate themselves from. They'll look at turnover of employees. Is it industry standard? Are they going to spend more money on bringing in new staff? And then more often these days, they'll do culture assessments and culture fits from a buyer perspective to say, if we're going to integrate you into our business or you're going to start working with our current employee base, what is your culture like compared to our culture? And is there a culture fit? Are we going to get synergies there, or the synergies that we expect there on an ongoing basis? They'll also look at your business from an IT perspective, and this has been growing in importance over the last few years. It's become very high on buyers' radars. They first want to understand what are your IT assets, what equipment do you own and do you lease, what are the applications that you run and license, how does that fit into the buyer's IT architecture. But they're also going to want to understand your history of cybersecurity incidents. They're going to want to understand what your security policies are and make sure that you don't have some type of undisclosed privacy breach that has occurred in the last couple of years that they're going to have to deal with or might have to deal with at some point in the future. So this area has become a pretty big kind of a hot button issue for folks these days, and people are more and more often bringing an IT specialist to analyze your IT environment. From a customer perspective, buyers are interested in customer concentrations and customer satisfaction. You might have provided them a piece of paper that says, we make $2 million a year, and they don't know, or if you didn't disclose and didn't discuss your customer base, they might not know that all of that, $2 million or 70% of that $2 million comes from one customer. Oh, well, there's a lot more risk in that type of customer relationship in that customer base than a diverse customer base. And that's something that they want to understand, and that could be something that impacts your purchase price. They'll look at the length of relationships that you have with customers, the major contracts, as we discussed earlier. And then they'll look at product concentrations amongst customers, and they'll look at margins by customers. Are margins going up? Are margins going down? Maybe your sales is diverse. You've got a bunch of customers, but there's really only 1 or 2 customers that are driving profitability. That's going to be an increased risk to them and something that they'd be interested in. All right. And then, they'll look at issues they might see in keeping customers post-transaction. Maybe it's a competitor that's acquiring you, or somebody that's in a similar industry, and your customers are competitors of their customers, and there might be additional risk there that those customers don't stick around post-transaction. All right. Throughout this process, buyers will start asking sellers to talk to your key customers. And those are things, when they want to start talking to your customers and your people, those are things that you kind of stagger and hold off. You don't do that week 1 or week 2 in due diligence. You push that off until the end to make sure that there's a little bit more certainty that this deal will close, since an LOI is non-binding. You want the purchase agreement to have traded hands a couple times and be pretty comfortable with the financial aspects of the deal before you start opening up your deal team and letting them talk to any of your key customers or employees or anything like that. That happens much later in the deal. All right. From a financial perspective, I bucket accounting concerns into really 3 buckets. The buyer wants to look at your business from an EBITDA perspective, typically, because that's typically how they priced your business. And EBITDA is quasi kind of term for cash flow. So they got a piece of paper that says that their EBITDA might be, or that your EBITDA, might be $2 million, right? And now the buyer's sitting there saying, well, how do we know that $2 million is a number that we can rely on? They send in their teams of accountants and advisors, and they'll typically request 3+ years of financial information, and they'll start going in and doing their own due diligence. They'll take into consideration whether you have, what level of assurance that you've gotten in the past as far as financial statements go. If you've gotten an audit from a reputable firm, there's a little bit more comfort there. If you've just got internal cash basis financial statements, a little bit less. But they'll start digging in and understanding and want to understand kind of what your revenue recognition policies are in the manufacturing and distribution space. They're big on understanding if you're on the percentage of completion basis for long-term contracts. How are you doing that? Are your estimates accurate? How are you accounting for inventory? How are you accounting for work in process? They're going to dive pretty deep into those areas and make sure you're accounting for those in accordance with GAAP. Similarly, they'll look at management estimates like slow and obsolete inventory reserves, and understanding how you make those estimates, make sure they agree with them. They'll want to validate any add backs that you might have proposed. So we talked in the first part of the series about how a business owner might pay themselves $500,000 a year, but their fair market value is $200,000. So you're adding $300,000 back to EBITDA. They'll want to validate that type of stuff and get comfort with the information that you've given them. The other 2 areas really are net debt and working capital. So debt, we might think of as pretty cut and dry. Debt is, my line of credit or a long-term note, something that bears interest, but that's not always the case. If you think about other liabilities that you might have on your balance sheet, take customer deposits, for instance, those are things that oftentimes require negotiation and might be something that the buyer wants to consider debt. So if you think about it, most deals are cash-free, debt-free, meaning that the seller keeps the cash, the buyer acquires the business free of cash, and the seller has to pay off their debt, and the buyer acquires the business free of debt. But if you do that, which is common, and you think about customer deposits, maybe a customer gave the business a big deposit the day before the sale, right? And that deposit's sitting in cash, and now the seller gets to keep that cash, but the buyer still has to fulfill that obligation. A customer gave you money to do something, and now the buyer has to deal with that, right? They might say, well, hold on, we're not comfortable with you taking all that cash because we don't want to invest cash day one of the business to pay off this obligation. So maybe there's going to be, some percentage of customer deposits that we might agree to, we might agree to retaining some percentage of your cash to account for these customer deposits rather. And those type of things become very important when you're getting multiple offers, because in our experience, those types of definitions can easily creep into the millions of dollars worth of adjustments. And if you're looking at multiple offers, you're looking at 3 LOIs, and you've got a bunch of customer deposits on your balance sheet, and one guy saying, well, that's debt, and the other guy saying, we'll assume it. Those are two very different financial deals, and those are things that you want to flush out in advance, often before an LOI is your best bet. And then finally, this gives the buyer, this process more insight into your business, the seasonality, and more of an ability to understand your working capital and working capital needs. We talked about this in the prior series a little bit, but just as a refresher, the goal is in working capital to have the business transacted in a way that the buyer doesn't have to inject a bunch of cash day two to keep it going. I actually like to steal an analogy that I heard from an attorney on a deal that I was working with, and he relates working capital to kind of a grocery store. Consider you're buying a grocery store. If you bought a grocery store and you walked into the store the day after you bought it and there was nothing on the shelves, you're not going to be very happy, right? You're going to cause pretty big impact on your revenue, on your profitability. You're going to have to invest a bunch of money to get that product on the shelf so you can sell it. But from a seller's perspective, you're sitting there saying, well, I don't think that I should have to fill my shelves for you. I never have full shelves. I have something in between. And working capital is agreeing on and negotiating what that number is in between, right? Typically it's an average, it's a 12-month average. And in your guys' case, the product on the shelves is your inventory, your accounts receivable, and your accounts payable primarily, right? So what's that average balance? What's that reasonable level of those accounts that will allow the buyer to maintain your business on an ongoing basis? COVID interjects a few complexities into these equations. If you've got a PPP loan that is considered revenue for you, that's not recurring, so you're going to have to navigate those waters of making sure that you present EBITDA in a fashion that doesn't account for those types of one-off things. From a working capital perspective, a lot of times you might give customers extended terms. So if you're closing sometime in the near future, you might have the June, July, and August periods in your working capital calculation where your AR is higher than average, right? And that means that you're going to give the buyer more at closing. Those are things that you kind of want to look through and normalize and are negotiated in the deal. But that's kind of what people look to from an accounting perspective. I'm going to turn it over to Nick here to talk about the tax perspective.
So what are buyers looking for with regard to tax due diligence? What's the aim of tax due diligence? Well, from a very broad perspective, it's uncovering anything that the buyer needs to know or should be aware of before closing the transaction. So the primary objective is generally a review of the target company's information to determine what potential tax exposures the buyer is taking on. So what risk is out there that the buyer needs to be aware of? It's all about eliminating surprises. A buyer doesn't want to acquire a company and then a couple of years down the road get an assessment letter from a jurisdiction saying that they should have paid tax and that the jurisdiction is owed tax, but then the buyer has no recourse against the seller because they didn't know about it. They didn't build it into the purchase agreement or take some other steps to make sure they were protected from that liability. So due diligence aims to uncover any of that. I often look to the standard representations and warranties in the purchase agreement. They outline the things that the seller is repping to. And one of the standard tax reps is that the target has duly and timely filed all tax returns required to be filed with all appropriate government authorities. Each such tax return was true, correct, and complete in all respects. All taxes due and payable, whether or not shown on any tax return, have been timely paid. So that's almost like a playbook to what tax due diligence is. It's making sure that each of those statements is correct. So if we take the first one, the target has duly and timely filed all tax returns filed with all appropriate government authorities. So is that correct? Or has the seller, the target, failed to file in a jurisdiction that it should have? So maybe they were doing some installation in Kentucky, something that goes beyond sales solicitation, which is normally protected from income tax nexus. or maybe they set up an office in Germany and so they created a permanent establishment and they have a filing obligation, or maybe they just forgot to file a return in Canada. All of these things happen, and it's up to the due diligence process to uncover those and see what the potential exposure that exists is. And then for the returns that were they filed correct and complete in all material respects? And in the world of tax, correct can be a subjective term. There may be computational errors in the return, or something didn't get transferred to the return properly, but more often it's reviewing the tax positions taken by the target company to see if they're reasonable, or to see if they were too aggressive, or if they're involved in tax shelters. It's seeing if there's income that's been understated or deductions that have been overstated that can be under scrutiny if the company is ever examined by a tax authority. At the end of diligence, we'll collect all the potential exposures and put them on a table so that the buyer can see what's out there. The table of exposures will often list the nature of the risk, the type of tax that it applies to, whether it's income tax or sales tax or some other tax, the likelihood or the probability. It can be a high risk, something that's clearly in error on the return, or somewhere they certainly should have filed, but they weren't filing. It could be medium, maybe an aggressive tax position where they can negotiate with the local authorities and maybe get it resolved, or get the amount of the assessment reduced. Or it can be a low risk. Maybe they've taken the right position, but they just don't have the documentation required by tax authorities. So we'll assess, apply a risk probability to those, and then of course the amount of the exposure or the range of the exposures, if it's not possible to nail down a specific number. So the buyer will have this table of exposures, and they'll have to decide what to do with them. As I talked about earlier, there are a range of possibilities. They could build these into the reps and warranties, into the purchase agreement. They can reduce the purchase price because there are these risks out there. They can set up an escrow that can be used to pay out any assessment that comes down the road. So a number of possibilities that are out there for dealing with these potential tax risks. So in addition to reviewing the company's information and seeing if there are risks out there, one of the things that tax due diligence can assess is the target's profile post-acquisition. And what I mean by this is both the profile of what you're getting, what legal entity and what their tax obligations will be going forward, and then what's within that entity as far as tax attributes and other tax matters. So from a structural perspective, it's important to understand what you're buying. Are you buying a corporation, the stock of a corporation that will remain a corporation? Are you buying an S corporation that was a flow through, but because you're an ineligible shareholder, it reverts back to a corporation? And then what else is coming along with that? Are there subsidiaries of that corporation? How have they been treated? Have they been disregarded entities, or are they controlled foreign corporations? The acquisition period is a great time to look at the profile and see what the best means of acquisition is and where best to put it in your structure. Maybe there are a couple of business lines that you want to hold separately that you're going to carve out later. So it's a lot more simple to do that sort of structuring in conjunction with the acquisition than it is to later look at the structure and decide that you need it unwound or moved around. So the due diligence process is a great time to look at that. And then from the perspective of what's within that entity, are there tax attributes? Are there net operating losses? Are there credits? Are there other incentives or property tax abatements? And do those carry over to the buyer? If you're acquiring assets, often those attributes and credits will stay behind. But if you're acquiring stock, then they'll generally come with the entity that you're acquiring. But they can be subject to limitations. So it's important to understand that. If you're acquiring an entity that has net operating losses, but there's been a change of control, then those losses are subject to the provisions of Section 382, which limits the use of those losses. So a lot of this gets to cash flow post-acquisition. A buyer always wants to know what sort of cash this target entity is going to generate after acquisition. And nothing eats into your cash flow like taxes, because it can be a huge chunk of your income. So a buyer wants to understand, what's the cash taxes? Is it going to be 30% because they have full federal tax and state tax and some high tax foreign jurisdictions, or is it going to be something lower than that because they have these tax attributes, they have net operating losses that they can use against that income and maybe pay a lower cash tax rate in the first few years after acquisition. So understanding all of that is part of the due diligence process. And then the last point there is alerting the buyer to tax opportunities. So I talked a little bit from a risk perspective. We're looking for whether income was understated or deductions are overstated. You could have the opposite situation where income might have been overstated and deductions understated, and it provides some opportunity if this entity is acquired. I started working at a company shortly after they had been acquired, and one of the things noted in due diligence was that the target had entered into long-term contracts, 3-year contracts, but they were recognizing all the income for tax purposes in the year that the contract was entered into. And there's an IRS revenue procedure, 2004-34, that allows for deferral of that income. You don't have to recognize it entirely upfront as long as you've met certain conditions. And so we were able to file a 3115, change the method of accounting for that to defer the recognition of that income. And it was a very significant savings for the company. It was a $90 million adjustment. And it is timing, but because the company is always entering into contracts, it's more of a permanent timing item. And it gave the buyer, the target company, a loss in the first year that it was able to use in the second and third. So it wasn't paying any taxes for the first 3 years after acquisition. So that was a huge cash flow benefit to the buyer that was uncovered as part of the due diligence process. So the due diligence team can always look for those types of opportunities. So what level of tax due diligence is needed? And it really depends on a number of factors. I've listed out 4 here, but there can be others. So it depends on the type of acquisition. So if you're acquiring stock, generally the tax liabilities of the entity that you're acquiring carry over to the buyer. And so if there's a tax assessment against the buyers, against the target for a pre-acquisition year, that liability remains in that corporation. So it'll be under the buyer's watch, so that'll have to be paid. So that's why it's important to build those in to the reps and warranties and perhaps set up an escrow if needed. Whereas if you're buying assets, then generally the income tax liability stays with the selling entity. There are other types of liabilities that can carry over that we'll talk about on the next slide, but from an income tax perspective, generally the asset acquisition is safer from a buyer perspective. It can depend on the type of entity. So a corporation, if you're buying the stock of a corporation, again, you're taking all that liability with you and taking on all that liability. If you're acquiring a pass-through entity like an LLC that's taxed as a partnership or an S corporation, that income had flowed through to the shareholders, to the owners on a K-1. So the entity itself did not pay any income tax. And so that there's no liability from an income tax perspective that goes to the buyer. The level of due diligence can depend on the strength of the reps and warranties. If you have strong reps and warranties built in, if you've uncovered issues and those are specifically highlighted within the purchase agreement that the seller is retaining that liability, then maybe you can give a softer touch to the due diligence because you don't need to dig into those specific liabilities that the seller is going to retain. And then the last factor that can impact the level of due diligence is the size of the acquisition. And this is actually counterintuitive to what you might think. I've often found that the smaller the due diligence, the more you really have to dig into the tax issues, because from a proportional perspective, if you have a couple $100,000 tax risk on a $5 million transaction, that can be very significant. If you have the same couple $100,000 risk on a $50 million acquisition, then it becomes less of a significant issue. It can be dealt with through other processes, or maybe the buyer is willing to take on that risk. So I've often found that the smaller due diligences require, or the smaller acquisitions require quite a bit of due diligence. The largest transaction I had ever worked on, it was a $21 billion acquisition, and we're getting ready for due diligence. And I thought we're going to have to be really thorough. We're going to have to uncover every rock out there because this is a really big deal. But the buyer really didn't want to hear about $1 or $2 million exposures. They really didn't want to hear about too much on the tax side. They were determined to go through with this deal. It was really only if we had uncovered something really egregious, if they were sheltering all their income in a tax haven, that this deal was going to be impacted by tax, and that wasn't the case. So on the bigger acquisitions, sometimes they don't care as much about tax. They care about more the operational issues. We can move on. So we talked about the liabilities of a corporation carry over to the buyer if you're acquiring stock. So what level of due diligence do we need to look at if we're acquiring a pass-through entity? So as I said, if you're acquiring an LLC taxed as a partnership or an S corporation, then they didn't pay income tax. All the taxable income flowed through to the owners who paid tax at the ownership level. And so there often isn't a high level of income tax due diligence that needs to be done, but there are some other areas that need to be looked at. And one of them is for the S corporation. An S corporation due diligence is unique in that often the focus area is whether it was a valid S corporation through its entire existence. So again, an S corporation passes its income through to the S corp shareholders. However, there are specific requirements to remain an S corp, and if they've invalidated the S corp through violating one of those requirements, then it really should have been a C corp, and there should have been tax liability at the corporate level. So it's making sure that the election was made properly, that all the shareholders were eligible shareholders, that there was only one class of stock issued, that there were no disproportionate distributions. So that's often the focus of the S corp due diligence. As far as pass-through entities, the state income tax generally flows through to the shareholders or owners as well, but there are state franchise tax at the corporate level that need to be reviewed because that liability can pass on to the buyer. And then indirect taxes generally passes on to the buyer, both in the acquisition of a pass-through entity and the acquisition of assets. So if you have property tax and you're acquiring an entity with that property intact, then that liability carries over to you. There's sales and use tax and payroll tax, and in most jurisdictions, that liability would carry over to the buyer. So due diligence of a pass-through entity would have to include a review of those particular areas. So what items are reviewed during the tax due diligence process? So obviously the tax returns, and this will be stretching back during the period of any open years of the target company. So for federal purposes, it's generally 3 years. For a lot of states and foreign jurisdictions, it's 4 years, but that can be extended if there's a significant substantial underpayment or fraud. It can be 6 years. If a company hasn't filed in a particular jurisdiction, but they should have been filing, then the statute of limitation never expires. Then the state or local authority can go back to the beginning of time and assess what they think was the tax from all those open years. So it can be very risky when a company should have been filing in a jurisdiction, usually a state jurisdiction or a foreign jurisdiction if they've created permanent establishment, but have never filed a return because the statute of limitations has never begun. Another area to look at during the tax due diligence process is the financial statements and other non-tax items. I find that this area often provides more insight and more information than the tax returns themselves, because the tax returns are prepared by the target. They're the view of how the target sees their tax liability. But the financial statements, especially the notes to the financial statements, can point out other areas where maybe the target return didn't report these items or didn't report them properly. So one area could be revenue recognition. Again, going back to that revenue procedure, there's specific ways in which tax revenue must be reported on long-term contracts. The notes can point out debt, related party debt. Maybe the company is deducting interest expense on payments to a foreign party, but they really shouldn't be until the cash is paid. It can point out intercompany transactions where transfer pricing has to be looked at. So some of these non-tax resources can be great avenues to see what the target should have been reporting on their tax returns. And then a third area is examination reports. If the company is under audit in a particular jurisdiction, we can look at those reports and see what the examiner is focused on. If it's an income tax examination, maybe they're focused on some of the foreign reporting or the transfer pricing. Maybe they're focused on meals and entertainment or other areas. So the examination reports and the IDRs, the document requests issued by the taxing authorities, can be a good resource for seeing where there might be risk areas. So we've talked about what the buyer does during the due diligence process, what they're looking for, but what should the seller do? And there's plenty they can do in advance of the sale process. And the first thing is really to be prepared, to get ready for the buyer coming in and asking those questions. So it's understanding the returns you filed, where you've been filing, if you haven't been filing somewhere, what your position is to not file in that jurisdiction, what's within those returns, some of the book to tax differences. It's as a due diligence on the buy side due diligence, if we go into a company and the seller really understands the tax return, they can explain items within that tax return. It gives the buyer and the due diligence team a lot of confidence that the tax items have been handled properly. So as a seller, really the best thing that you can do is be prepared, understand the tax information that's out there, have it assembled and ready to go when the buyer comes in and looks at it. Another option is to do sell-side due diligence. This is, from a tax perspective, this is fairly rare. Have been involved in about 200 due diligence projects, and about 5 of them were on the sell side. So it's quite rare, but if it's a great way for the seller to be aware, to be proactive and take the first step and understand what's out there. And if there are some risks, maybe they can take steps to mitigate that before the buyer even comes in. So if sell-side due diligence points out that there's a jurisdiction that they should have been filing in, maybe they can enter into a voluntary disclosure agreement with the local jurisdiction to only go back 3 years and file those returns and get all that cleaned up. So sell-side due diligence can provide benefit from that perspective. And of the sell-side due diligences I was involved with, a couple of them ended up being where the seller presented that to the buyer, presented the report that was provided, and the buyer didn't do their own tax due diligence. They relied on the seller's report and looked at those exposures and negotiated what to do with them. So being proactive on the sell-side due diligence can prevent the buyer asking questions and digging into things further. And then where possible, move exams along, get returns filed. This isn't always possible in some cases. If you've extended the return, maybe it's not possible to file early and get that completed return to the buyer so they can look at it. But if there is a chance to do that, it just alleviates some burden on the uncertainty of a return that you haven't even filed yet. And then as far as exams, examiners are notoriously slow. They will request something, you'll give it to them within 30 days they requested, and then you may not hear from them for months. But having open exams during the due diligence process is really a red flag for the buyer. So to the extent possible, to move those along, to call the examining agent and see what else they need, what other areas they'd like to look at. And if the field agent isn't moving along, to call his supervisor, the manager, and try to move it along. And you can be honest, just say, we've got a transaction coming up. We really need to get some closure around these exams. And they'll usually do their best to try to get that moved along. And then there are tax clearance certificates that can be obtained in Michigan. It's the Form 5156. So that's just says from the state that there are no outstanding tax liabilities. It doesn't necessarily mean that the seller, the target, has filed their returns correctly, but just that there's no assessments that haven't been paid by the target company. And now Ben's going to go into some of the other things that the seller can do from a non-tax perspective to get ready.
Yeah, so I don't see any questions here. I think in closing, we might sound like a bit of a broken record throughout this series. It's like plan, prepare, an ounce of prevention is worth a pound of cure. But that really, I think that's really the best course of action. A study, this is a couple years old now, it was from the Middle Market Research Center, found that 45% of sellers entered into their last transaction as a result of an unexpected opportunity. So, if you're not running your business like you are for sale, there's a good chance that you're going to lose value. Buyers look at the health of your business, the financial health of your business, oftentimes differently than you do. In the manufacturing space, I think owners come up with their own set of KPIs and their own means to assess, well, am I on target or not? Buyers oftentimes don't look at your business the same way. They look at your business in terms of GAAP. They want you to connect, the way you see performance to, well, how does that affect the bottom line, right? And I think understanding that, and kind of increasing the quality of your information that you can produce and that you rely on can go a long ways to help you preserve value, and not only preserve value on exit, but also kind of reduce risk. A lot of the things that we talked about today, if you think about and start considering them now, they'll reduce your overall risk as a business owner, and they'll maximize value on exit. I find that a lot of business owners, they've got a lot of irons in the fire. They have competing priorities. They've got customer issues that they have to deal with. And this is just something that, I'm going to sell maybe at some point in the future, but this is not my most pressing issue. I'll tell you, if you sit down with some advisors, someone that's done deals, in the course of a few hours, you can probably identify quite a bit of low-hanging fruit. We'll do something called like an accounting policy review, where you can talk to folks in your organization. We can talk to folks in your organization, not in the context of selling, but just in the context of how you run your business. And we can find, folks can find relatively low-hanging fruit and small changes that you can make or your people can make that will make big changes to you on an exit or in the future. So that's all Nick and I had for today. So we're going to turn it back over to Jim here. And I don't see any questions that we have, so I'll turn it back over to Jim.
And I'll turn it back over to Caroline because we don't have any questions. So if there are any questions, we're available, obviously, with our, in the end of the session, there's our email addresses that you can track us down. We'll be more than happy to answer any questions that you might have. Go ahead, Caroline.
Yeah, thank you. So first of all, I'd like to thank our panelists today, Jim Beal, Nick Lloyd, and Ben Smith. Thank you for all of the insights you've shared today. To our participants, we encourage you to reach out to any one of us for your thoughts, questions, or just to chat and brainstorm. Both Clayton and McCurvey and MMA have a vast array of resources available to support Michigan manufacturers. So be sure to check out our websites at claytonmccurvey.com and mimfg.org. Once again, thanks everyone and have a great day.